Doug Holtz-Eakin, who's one of the 10 FCIC commissioners, and he joins us from our New York studios now. In fact, Doug also served as chief economist, by the way, for the President's Council of Economic Advisors under George W. Bush. Doug, being tough there, let me just ask you about that exchange. It seems like the Oracle of Omaha, Warren Buffett, saying, hey, I'm just an investor in this company.
Well, he has said for a long, long time that when he looks at a company, he's looking for long-run value. He's looking for integrity and preserving the key assets for the company. We heard a lot of testimony today that said that they sacrificed their key long-term asset, which is their reputation, in the interest of short-term market share, exploited their pricing power, and made a short-term gain. So I was very interested to see if there was a real disconnect between what his investment strategy is supposed to be and the actual corporate governance that we saw at Moody's.
Okay, well, Buffett was deflecting. He's saying really that the focus shouldn't be placed solely on the ratings agencies. I mean, you have a lot of other people, a lot of other CEOs at fault, including the ones at the top of these bailed-up financial firms.
Well, I think that he has a good point in the following respect. What we learned today is that Moody's, Standard & Poor's, Fitch didn't do a good job in some of the ratings. I think that was well known. What we saw today was some of the explanations why, both from a technical point of view and perhaps because of their business model. But what we didn't really nail down today is how important were bad ratings for the overall financial crisis. Mr. Buffett, for example, pays no attention to ratings in making his investments. How many other people were like him, and how many people were actually misled by the ratings they saw and thus contributed to bad portfolios in the big financial crisis?
Well, that is a question, Doug. I mean, we have Phil Angelides, who's the head of the FCIC, saying that some of these transactions were equivalent to fraud. I mean, do you see it that way?
I think fraud is a strong term. I'm very interested in the answer to the question. If another person had been the analyst at Moody's, had been the CEO of Moody's, would they have done the same thing in the same circumstances? We had a crisis that was driven by bad incentives, a big housing bubble, all sorts of problems. Other people may have done the same thing. That's not fraud, but that's a real financial crisis.
Okay, Doug, we're running out of time here, but what should be done? I mean, everyone always points to this inherent conflict of interest between the ratings agencies and also the Wall Street firms who pay them to rate their securities.
Right. I tell you from the bottom of my heart, I don't know. Ratings provide information about particular investments. Once the information's out there, it aids every investor. So the question becomes, who's going to produce that information, and how are you going to get real discovery of risks? The model we have so far has worked in many circumstances for a long, long time. It failed miserably in this one. So I'm not ready to throw it overboard, even knowing the conflict of interest, and I don't know what a better one might be.
Okay, Doug, nice talking to you. Thank you for sharing your time.